largely around pension. So someone is saying, as an American living in Dublin, married to an Irish citizen, per the treaty, what pension types are considered qualified in either country? Unfortunately, the treaty isn't specific at all. US 401ks and IRAs, are they recognized as qualified in Ireland, and vice versa. From a US perspective, she's absolutely, she or he, whoever submitted this, is absolutely correct in that what is recognized as qualified is defined in the tax code for that country. So in terms of, because what people are essentially looking for is a tax win. So in terms of a relief that reduces your taxable income, contributing to a foreign or non-US, even though it may be qualified in that other jurisdiction pension plan, it won't give you that tax relief. On the other side, when money is being pulled out, if it's from a foreign qualified plan, then yes, under certain circumstances, the treaty would allow for a tax benefit on the US side if you're pulling out an Irish pension in Ireland. So yes, on the withdrawal side, but largely no on the contribution side. Damien?
Yeah, so what we spoke about, DERREN, just before we went on the call as well, and the distinction between the two that we can see in Ireland, like this concept of like a qualified scheme or not, like really every scheme in Ireland is a qualified scheme, like, because it has to be set up in that way. It's not like the example that you made, DERREN, where in America, if you have like taken a self-directed scheme and it's investing in stocks and shares and that sort of thing, you're actually paying. It's actually the scheme itself is more or less disregarded from what you said, and you're paying your income tax, based on gains that you've made from that through the scheme. That's not what it's like in Ireland. Once you follow, and once the scheme or the trust or whatever structure it's set up by the pension people is done and is approved by the tax office, it can really invest. If you're controlling it, it can really invest as you see fit within the pension rules. And if it's under someone else's management, they do the management for you and so on. Like they all qualify. The issues, I suppose, from an Irish pension side or an Irish pension scheme side is just ensuring that, I suppose, you don't take away the good of a pension scheme by over contributing and ending up having a fund that's in excess of what we call the standard fund threshold, because it just gets inefficient at that point. So once you plan your contributions and aim to try and project your fund to get it up to a level, if you're fortunate enough, the equivalent of what we call the standard fund threshold, that would be how one would go about optimizing their pension arrangements from the Irish side. But we're not. If you set up a self-directed scheme, as we would encourage a lot of our business owners to do, you can invest in whatever you see fit, subject to the normal pension rules, and it rolls up the gains and the income from that roll up tax free, and there's no, you're not deemed to, it's not considered not qualifying because of what the what it's invested in.
Right. So that great.
Please subscribe, like, share, and comment below. Our books and upcoming event are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.